I might get started as it's 1 o'clock, and I just wanted to welcome everyone on behalf of Employee Ownership Australia. I'm the chair of that organisation, and it's a delight for me to be able to put forward the two presenters we have today who are going to talk a little bit more about employee ownership, particularly in private companies and some of their journey. I don't think I want to give too much more of an introduction because I think their stories really are very speak for themselves, I guess. So I can't see that David is on the line at the moment. So what I might do is start with Steve, who is, as you would have seen from the Eventbrite page, someone who has a lot of experience of employee ownership, particularly. I met Steve a while ago, virtually online, and we were talking a little bit about employee ownerships and some of the things that he observed in his company. And I was particularly interested in his story, which is one of the reasons why I've asked him to come today to speak to everyone. So what I might do is I'm literally going to hand over now to Steve so that he can share his screen and go through his presentation. And just a few things, I guess, for everyone on the line. We've muted everyone in order that there's no background noise. But if you do want to ask any questions, there's a chat box at the end, at the very bottom of your panel. So do type in any questions as we go through the presentations, and I'll make sure that I put my hand up and make sure that Steve or David answers those questions for you. So without further ado, what I will do is I'm going to mute myself and unmute Steve so he can speak to you a little bit about his experiences. Steve, are you there?
Hello.
Great.
Yeah, Angela, can you hear me?
I can. Fantastic.
I'm coming through. Okay, terrific. Thanks very much, and thanks for the introduction, and thanks for the invitation as well to present, the experiences that I've had in this area. So I've just put together a few slides, which I'll go through now. Um, the outline of what I'm going to talk about goes along these points, basically, of a bit of an introduction as to the company, the type of company that we had, and the philosophy of the scheme, the employee ownership scheme that was put together to manage that company. I'll talk about the administration of the scheme. I was in 2005. I became the company secretary, so I was quite heavily involved in administering the scheme on an annual basis, basically, which I'll talk about a bit further in a second. And then the third bullet, there's some challenges. So we literally were operating the scheme, I think, from the seat of our pants. We didn't have a lot of go-bys. We were really tackling hurdles as they came and managing our way through that. So I'll touch on some of those. And interestingly enough, in 2013, the company undertook a sale process, which might seem against the whole principle of employee ownership, but there were various circumstances that were sort of dictating that was the best course of action for everybody, employees, employee shareholders, and employees who weren't shareholders as well. So I'll talk a bit about how that worked in an employee-owned company, and then just some closing remarks. The company is a West Australian company, was founded in 1994. Advanced Geomechanics, we were a group of geotechnical consulting engineers working in the offshore oil and gas sphere. So it was very much a niche consulting business. We had a very specialised area of engineering that we supplied to the industry, the oil and gas industry. It was founded by two sort of leading professionals in the area who were based in Perth. It also had four university professors who were founders and non-executive directors. So we had a very strong linkage to university and technology. And I joined basically at that point when there was just the two people, and in the formative year. Because we were filling this niche, intellectual property was very important. We had the linkage with the university was used really to leverage research findings and commercialise them and implement them into the industry. So it was a good a flow of technology between the university and the company. So we very much prided on the quality of our product, and I think that's those things, intellectual property, developing that and retaining that within the firm, and using that in the industry and providing the best quality of advice, really leads to that point there about employee retention being a really fundamental success factor for the company. It takes a long time to bring people up to speed and into a professional consulting environment, and it's losing people is the worst thing that can happen in a niche consulting business like that. And so that all sort of leads to the last point, that employee ownership was really viewed as a key element to attracting and retaining staff as long as possible. In fact, we had a very good track record through the 20 years. We didn't lose one employee to a competitor over those years. We had employees left for various other reasons, but we were very successful in retaining people for the long term. So the philosophy, that kind of leads on to the philosophy of the scheme that was developed, which is basically, fundamentally, the first point there is 100% employee owned. That was pretty much a given, and because it was a consulting company which didn't have a lot of capital requirements or startup funding, we didn't need passive investors, we didn't need any sort of venture capital, or we didn't even take on any debt. We essentially just grew organically from a very small base, and kept the ownership inside the company. The spread of ownership was really, the philosophy was to have that reflect the contribution to the company of the various staff members. So on various bases, whether it be seniority or period of service or importance to the company or some key element, essentially we were sort of striving to spread the ownership across the group in a way that sort of reflects how people are able to contribute to the firm. Again, that was a principle, whereas the detailed shareholders agreement really described things like, fundamental things like the share classes and the rights. We had two different classes of shares, which I won't go into detail on those today. It also described how shares were valued, or how the company was valued, and therefore the share price. Described succession events as in terms of retirement or resignation, and what happens to shares in those circumstances. Even though these were very sort of prescriptive procedures that were set out, I think it's fair to say they were hardly ever used. We almost always negotiated our way through mutually agreeable ways of managing any sort of transition, and the sort of the cut and dry succession events in the shareholders agreement were really a fallback. So yes, we had, and I guess the final feature there is really that there was sufficient flexibility in the shareholders agreement to cater for changes over time. So the agreement itself lived for 20 years with very small modifications over those years. The sorts of things that it was silent on were things like qualification criteria, and when employees were invited, I guess they were invited rather than entitled to buy shares, the amounts of shares offered, the dividend policy, all of those things were really kept as flexible matters that ensured that we could adjust with the times as the size and the nature of the company changed over time. So that's a bit there on the sort of background of why we put the scheme in and roughly how it was fashioned. I'll talk a little bit now just about how we administered it, which is obviously, as I mentioned at the outset, was very much we were feeling our way through as we went, and in the early years it was quite easy as we were a smaller group, but we grew to 70 professionals and we had 29 shareholders until the sale. So it became quite a significant undertaking. So, as I just discussed, shares were offered really to employees by invitation. So there wasn't a sort of a right for employees to be entitled to shares. It was more a case of, I guess, it was more of a qualitative assessment to see, when we think people are ready to take that step and to what extent. We got into a routine after the early years of having annual transfers at one point every year from outgoing shareholders to new upcoming shareholders. And when I say outgoing shareholders, they were generally the founding shareholders. And the third point there really relies significantly upon goodwill of everybody involved. And by that, what I mean is, just as there was no obligation for, no right, sorry, for employees to be entitled to buy shares, unless any of the founding directors decided to leave the company, there was no obligation for them to sell shares either. But they had enough foresight and vision and and knowledge to know that hanging on to shares until they walk out the door one day is really not a good way of managing things. So they were really very good at slowly but surely providing some shares to get the younger people involved and into the company and embedded basically into the company. So that was an annual negotiation effectively between the founding shareholders who were prepared to sell some shares over a small amount every year over a significant period of time, and the younger guys who were quite keen to buy into the company. And the last point there is that we basically transferred shares directly between shareholders. Again, there were some issues of new shares in the early years, and I think a selective buyback at one point. But they're very difficult and cumbersome really to administer, with requirement to obtain sort of unanimous shareholder consents. Whereas one shareholder selling shares to another shareholder is a very simple matter. It's essentially between those two shareholders. It's facilitated by the company and it's approved by the company, but the transaction itself happens between two shareholders. And we ran like that probably for 10 years without issuing any new shares or changing the share capital of the company. In terms of the challenges that we had, I think there was a few. To be fair, we were very much, I guess, tackling issues as they arose, and rather than having a very clear and rigid framework for how the scheme would be run. So effectively, I think that really helped in some instances by having it as a more of a flexible type of scheme. But I think we also did suffer from having a little bit of a lack of sort of templates and guidelines for administration and how other companies were doing it. When I started in that role, I did do a search for assistance in this area, things, the type of work that the EOA does, and this was in 2005, I think, before the EOA was formed. So there wasn't a lot out there in terms of information about how other people do it. So we we spoke to our accountant and our lawyer, and it really took the scheme where it went on that kind of basis, rather than having a too rigid a framework. But I think a lack of guidelines was did create for some uncertainty at some points in time. I think the second point there
Steve,
is lack of incentive.
Steve, I apologise, just to interrupt you. I've got a question. Would you prefer me to leave them to the end, or are you happy to take it now?
Very happy to take it now. I can see it there on the screen.
Yes.
Do you want me to answer that?
Yeah, it relates to valuation. So one of the participants has asked, how is the shares valued, and are the shares valued at the time of the exchange? So it's about the valuation issue, which I think is probably common in a lot of private companies. So if you're happy to take it now, that would be great, Steve.
No, very happy to take it now. So the valuation, yes, there's a formula in the shareholders agreement, and that formula stayed true for the 20 years we're talking about. So it was quite robust. It was based on assets and as well as profit. So it was essentially, the cash backing of the company plus a small component of goodwill, based on a formula, a specific formula. It was valued relatively conservatively, but it's quite a small company, so you couldn't be too aggressive with the sort of earnings multiples. But so that was in our agreement. And then, are they valued at the time of exchange? You've preempted the fifth bullet that's on the screen now, which is we valued the shares basically at based on the accounts, the annual accounts. And we did come across an issue here, which I'll tackle right now, is that when we had periods of high growth, sometimes there would be up to 6 months would pass between the end of the financial year and when the accounts were signed off. And that did create some problems where sellers quite rightly were saying, well, hang on, the company's actually grown an extra X percent in that 6 months. So, by the time the valuation was done, compared to what that value was based on. So we sort of tackled these problems as they went. I think in that instance we paid an interim dividend to square things up, and then did the exchange. But from that point onwards, we developed a new process of striking an interim, or striking a price based on interim figures, basically at the 30th of June. So we would value them quite quickly, within a few weeks of the end of the financial year, and we would execute transfers in sort of late July, early August, based on the most recent financial year sort of interim figures. And being a consulting company with positive cash flow, it was pretty easy to get pretty accurate estimates in that July period. So hopefully that answers that question. But that's a good point, because essentially that was a little hurdle that we had to get over at one point. So I'll just jump back to the second point here about lack of incentive. So essentially we had each transaction was essentially fully commercial. There was no tax benefits, no discounts. We were advised that any discounts or any free shares, we considered issuing shares as bonuses at one point. But the sort of deemed income and tax that would be payable on that was going to create a problem. So they were conducted as fully commercial transactions from one shareholder to another, and I think I personally found that a little bit of a frustration that you know, the government doesn't differentiate between buying shares in the company that you work, I think, which results in a much greater productivity and for the company and the economy, but versus buying shares in a listed firm, which is a completely separate sort of passive investment. So we had conversations with employees along the lines of, well, you know, why should I buy shares in this company? I'm better off buying shares in another company that has got a much longer track record and is much bigger and less risky. So, you know, we had quite a few of those conversations, and I think generally, you know, people were happy in the end to buy shares, and I think in hindsight, very glad that they bought shares. So still, I think it was a challenge, I guess, to sometimes, you know, as it was having discussions with people to provide shares to sell, also encouraging younger people that it was in their best interest to try and purchase some shares. So I think having some incentive, you know, if there was some incentives in place, which I think they're starting to come into play now, it would certainly make that a lot easier to marry up the supply and demand. So that sort of flows on to the next point about liquidity. You know, some years we would struggle to scrape up enough shares, or, you know, a significant number of shares to sell. And other years, you know, we had one particularly large shareholder leave at one point, which created the opposite issue of having too many shares available. So that was a difficulty and something we managed on a year-by-year basis. And then the fourth bullet was about succession events not being binary. So retirement is a classic where in a consulting firm people often will scale back to 4 days a week or 3 days and so forth. So, you know, the shareholders' agreement doesn't come into play in that scenario. So that was, again, it was a case-by-case basis to try and come up with something that was sensible and fair to everybody. So I'll just move on now. I think I've taken enough time, but the sale process, I'll touch quickly on, you know, the fact that the company pursued the sale process in 2013. There were various reasons for that, and none of which was related to it being an employee-owned company. But that was deemed the best course of action for various reasons. We had 29 shareholders at that point, which obviously required a great deal of consultation with everybody to talk through the merits and the case for pursuing a sale. The company was acquired in about 2 years ago, and because of the wide ownership, there was a high level of buy-in and ownership of the decision, I think, probably much more so than if the shareholder base wasn't as wide and people somehow may have felt that they were you know, being sold off to somebody else, whereas everybody being, or, you know, a majority almost of people being involved and being able to partake, it did create a better acceptance and understanding and ownership of that decision, and because of that, I think the integration went pretty smoothly. It's always a very difficult thing to pull off, I think. Although, obviously, and I haven't touched on this much in this presentation, but longer-term cultural changes. There was not overnight, but certainly over time, there was the culture changed. I think it's fair to say, and culture is always difficult to measure, but it's a very different environment when you're working with a group of people who essentially are all working with each other as a team for a common ownership group, versus essentially, well, initially when somebody comes in, it feels like a third party, and people made comments to me about feeling dissociated from their employer, and I think other issues came in. We needed to strengthen policies and procedures, because whereas we used to solve issues by sort of simple discussions and agreements, we needed to have more prescriptive policies on things like entitlements and allowances and things, which we could generally negotiate very easily on a one-to-one basis with. Those kinds of things needed to be bolstered. So just to finish up quickly, it was a very effective model in retaining staff for a very long period of time. I think it helped their satisfaction levels too, and motivation. Attention to quality was also a comment that's been made, that working as an owner of the company subconsciously creates a driver to really be responsible for all of the product and the engineering advice that went out the door. So our quality was always the best. It was always came as the number one priority. It was one of the sort of drivers and visions for the company. The quality was still good after the sale, but I think it was exceptional during the employee ownership phase, and people really knew that if something bad happened, it could really affect everybody. And we worked in quite a litigious area, so and during our 20 years we haven't had one insurance claim or claim of any sort of litigation. So we did certainly achieve very high levels of quality. Administration of the scheme is sometimes difficult, although as a collective group we always solved issues as they arose. But I think there was definitely a lack of guidance in this area, and I found a lack of experience. So that was another takeaway for me. And I think, as I discussed earlier, the lack of incentives. I think having seen the company operate as an employee-owned group, and the power that gives to the group, was really tremendous. And I think it's a shame that there's not more incentive for other people to do that. We were lucky to have some founding directors who had the foresight to really encourage that scheme. But outside of that, there doesn't seem at this stage to be a lot of incentives to foster this type of model. So I think that's the end of my slides. I notice there's one other question that's come in. Do you want me to answer this one, Angela?
Yeah, that'd be great. If you could just for the purpose of the recording, if you could perhaps read it out, and I've got a couple of other comments as well, Steve. But I have to say the story is incredible to have 100% employee ownership and the commitment to that. So it's just fantastic, I think, to hear the story. So if you would like to answer James's question, and I'll open it up then to the floor. And perhaps if there's no other questions, I've certainly got a couple.
Okay. Well, the question from James is, how did you manage that in the instance of too many shares being offered for sale? In that particular case, I recall, I think we had a partial transfer, and I think the company bought back the rest. So that was the instance of the selective buyback, and it was interesting because we did at that point change our shareholders agreement, which had said that the company must buy back shares from any residual shares that were left over. But in the case of a large shareholder leaving, that can create solvency problems, really, to be honest. So we changed that to the company having the right but not the obligation to buy them back. But still, we were able, in that instance, the company did buy back the residual shares.
Steve, I think I was really, really interested in the story, particularly because you've been through the process of ownership for a very long period, and then obviously a sale and no employee ownership. So I just I had a bit of a question. I think you probably covered it in your slides, but clearly employee ownership was seen to have quite an impact on employees, and I think you mentioned particularly, Steve, around productivity. Can you explain in a bit more detail perhaps some of the things that are less tangible?
Yeah, okay. So productivity, yeah, so I guess culture, like I said, it's hard to measure, but there probably are some metrics. I think, yeah, without having looked at the data in any detail, I think we probably had an increase in absenteeism. People being off, whereas I think there's a different environment as an employee-owned company where you know that if something doesn't go out, it's really it falls. It's really going to affect you. So there was. I wouldn't say clock watching. I think I've got to be very careful because at the same time there was a real downturn in our industry. So there was a reduced workload, and so it's. I wouldn't say people were working less hours or anything like that. But I think it's just reflected in the quality of the product more than anything, which again it's a bit difficult to measure, but and people's real ownership of everything literally that goes out the door. So I think that's it was certainly my view that productivity was better under the employee-owned environment. Although again, I should be very cautious because really, at the same time as the company changed over, there was a massive a downturn that was really unforeseen in magnitude. So we had some issues really finding enough work for people at the same time.
Thank you. I think we've got another question, which is about did the shares have voting rights? So was there a control issue, I think, about maybe some shareholders having greater control than others? I think that's the question. So particularly about the voting rights attached to the shares.
Yeah, so we had two classes, which being they were called ordinary shares and Class A shares. Essentially, the board had voting rights according to the number of ordinary shares owned. So the voting rights at board level were attached to the ordinary shares, and they were only about 10% of the actual shares. The other 90% were all Class A's, which didn't have board rights, but they had all other rights in respect of shareholder rights. So rights to dividends, rights to key decisions for the company, so certainly the company sale decision. That actual model was put in place specifically because of wanting to spread the ownership wide, but keep the control at board level, so that the directors would own the ordinary shares and employees, the wider employee group, well, the directors would also have Class A shares, but the wider employee group would be invited to buy these Class A shares. So that's that was the difference in the voting rights, but certainly it's AGMs and those the voting rights were all equal.
Fantastic, thank you. I'm conscious of time, so that at least David has the ability to have a full swing. I think we've got one more question, and then I think I might hand it over to David, who's also got obviously some experience from his perspective. So I think the final question here is it's around metrics. Were there any metrics you can share around the individual performance attached to employees' value or contribution to the business? So were there any performance metrics?
The performance attached to employees. Okay. No, I think almost by definition it's a qualitative thing. For instance, you might have in our environment a key person might join, a very senior person might join, and she might be invited to buy shares very within the first year, virtually by virtue of their seniority, versus a fresh grad out of university who might be invited after about 3 years, or 3 or 4 years of service. So it's kind of, I think, deliberately vague to allow for flexibility in how it's done. I think the danger of being too prescriptive about having rights to purchase could create potential, issues. So by having it as a flexible scheme, we did our best really to tweak it year on year to try and reflect people's value to the business. I think that answers that question a little bit anyway.
Excellent. Well, I might thank you so much, Steve, for sharing all of those insights. I personally found it very, very valuable, so thank you. I'm going to hand over now to David Stephen, who is the CEO of a company called Acquire, and I came across Acquire I was, again, very interested in them because they chose to transfer ownership of 51% of the business across to employees, and just the journey that they would have had to go through in order to do that was interesting to me. And I know this was pre-changes to the legislation, so again, perhaps they had a more difficult path back then, but I thought it was really, really interesting for David to also share his stories. So I'm going to hand over now to David, and again, if you've got any questions, please just type them in and I'll make sure that David can see them, and we'll ask them throughout the presentation.
Thank you, Angela. Firstly, before I start, can I just make sure the technology is working well? You can see the screen and can hear me? Okay, so people can hear me. Good.
I can hear you definitely, David, and we can also see the screens. Apologies.
I'm getting a lot of yeses there, just to make sure. Sometimes I'm a bit unsure about the technology. The first thing I'd like to say is listening to Steve and his journey, ours is actually very, very similar, and he's come across a lot of the same issues, and in some instances come up with a lot of the same solutions, although some of the things we're doing may be just a little bit different to what his group had decided to do. And I'd also tell you, you talked about Acquire. In fact, the group we're talking about is a group called Metech, and when the shares are held in a group called Metech, Metech's the parent company of Acquire, and in fact there are other group companies now developing within the Metech group, which is relevant to what I'm going to talk about. So I'll be talking about Metech as a group as opposed to just Acquire, which Acquire is the principal company, revenue earning company at the moment, but we'll be talking about Metech.
Thanks very much for clarifying, David. I appreciate it. My mistake.
No, that's okay. That's fine. Okay, so the background to the company. We supply technology to the mining industry. So when I say technology, I mean software. And at this particular point, we had two streams of technology. One was a general mine planning system that we provide to the mining industry. The other was a database for recording geological information, which was available to mining and to exploration companies. We provided that information. Our revenue that we received through that was by way of selling licenses of the annual maintenance and support charges, and services and training that we provided to all of our clients. So we had two streams set up, and they were set up in two separate companies which were subsidiaries of the parent company. We had 4 founding shareholders. Now, we started looking at this seriously. We've been talking about it for a while, but we started looking at this seriously in 2006, and our scheme actually came into operation in 2008. The founding shareholders, the longest serving of those, had been with the company since 1981, another one since 1984. So they've been around for a long time and have been considering this issue of succession and how to hand the company over and where to go. One of the complicating factors we had in it was we had different shareholdings by each founder in each of the companies. So some of them had decided to put more money into the database technology, which is the acquire business, and some preferred to have more in the general mine planning system. So there was some unusual complications in there as to who owned what. So that was a starting point. We were in a period of rapid growth. At the time we really started seriously looking at this, we had about 50 people. But between 2006 and 2008, we grew from 40 to 80 people, with a corresponding increase in revenue and assets, and all the issues that go with that. We were opening offices around the world, so we had issues of people overseas to deal with. In fact, we had 6 offices outside of Australia. So so we were busy running the business at the same time trying to figure out what we needed to do with our shareholding. Our guiding philosophy in terms of looking at how to hand over the shareholding was we wanted to look at a multi-generational employee-owned company. We were looking at, we did the due diligence and looked at all the different options, and we had extensive discussions around them. So, we could have floated. We could have looked at a trade sale. In fact, we had many companies approaching us looking to buy into or buy the company. You could have done something like a management buyout, but ultimately we wanted the multi-generational employee-owned company, and we had a vision of a company that's going to be around for the next 30, 40, 50 years and still doing the things that we do and keeping the culture and the value going along. We decided that we didn't want the model where you had, $20 from your salary each week deducted to pay for shares. We wanted people to make a significant contribution. So this was an entrepreneurial decision for people to buy into the company that would require some pain on their behalf, obviously, to fund it, and we looked on it as any commercial risk that they would be taking. There'd be no guarantees around their investment. So it was a real commitment to people, and it underlined their commitment to the company, to a lifestyle, I suppose you could put it, in terms of, we wanted people to be here for a long time. It wasn't a model where we wanted people to buy in now and sell next year just to make a short-term profit. That is actually a commitment to the long-term future of the company and the group, and to themselves and to their future and their career within that. We wanted to ensure the culture and the values of the company carried forward as well. We're very big on culture. This is the central tenet of how we run our business. And in fact, we have started a new company in the last 18 months called Adapt that is very much about how to incorporate the culture and the values and how you run your companies, and it's got nothing to do with mining or technology or what have you. So we wanted to keep that culture, and we wanted to have the right people in the company to carry it forward, and getting them to buy in as shareholders was a way to minimise the risk of losing all those good people. The other thing was simplicity was become the key. The more we looked at it, the more we recognised how difficult it was. If you wanted to go with a traditional employee share purchase plan, scheme that was regulated and it had all the legal issues and tax issues that we heard Steve talk about, and we didn't want it to be complicated for people to understand. You need to be able to sit down in 10 or 15 minutes and explain to people what the model is, and for people to understand it. And also to administer. We don't want a major overhead in administering this. We want to put our time and effort into running our business, not running our share ownership plan. So that was what sort of the philosophy we were looking at, and we had a strong vision around that. So we ended up with where we got to, the decisions we made, and this again reflects what Steve was talking about. We ended up what we called a willing buyer, willing seller model, which pretty much exactly the way Steve's was, is each year we have one trading period. There is a valuation of the shares, and if you want to buy the shares, you buy at that value, and if you want to sell, then you sell at that value. But it is an exchange of shares between a buyer and a seller. We don't issue new shares in the company. We have the ability to do so, so our shareholders' agreement does allow us to dilute the shareholding by increasing the share capital, and it does allow us to have a share buyback as well, and I'll talk about that a little bit further on, because that is potentially one of our issues going forward. But we effectively want this willing buyer, willing seller model, and we do the valuation, and we have one trading period a year. It's an employees only one, and so we want 100% of the shareholder to be held within currently active employees of the company. Again, in a little while I'll talk about the issues that has caused us, or is causing us, due to the nature of how we operate our business or some of our newer businesses. But that's the philosophy behind it, only employees. There were qualifications required around how you got that, so it wasn't just anybody who was an employee. We had some rules put in place, and they have changed a little bit as we've gone along. So we initially said you had to have 3 years in the company, and you had to be approved by the board of directors, and that the board of directors approval really come back around culture and values. And one of the things we have done as a company over the years is really tightened up on our recruitment processes. We've worked very hard on how we can get the right fit of people into the company. So the 3 years used to be a model where you really get to know somebody over 3 years, and if they want to buy into the company, then you'd have a very good idea of whether you want to work with that person for the next 10 or 20 years and be effectively a partner with them or not. And because our recruitment processes were not as good as they could have been a few years ago, then it was taking us that length of time to really get to know someone. Recently, we have improved our recruitment to such an extent that we find that our hiring in terms of values and culture is so much better that we're questioning whether the 3-year rule is too long. In actual fact, we get people who are very keen to buy into the company well before their 3 years, and we run the risk of losing people if we can't offer them that model where they can do so earlier. So that's something we're considering at the moment. But you had to have the 3 years, and you had to have the approval of the board. And again, as I said, one trading period. We don't want this to be complicated. We don't want to have a major administrative overhead for it. So it happens once a year. There are exceptions to it. Obviously, we have a hardship clause. So if somebody is experiencing hardship in their personal life, then the board can approve a sale or a trade outside of that period. Or potentially if somebody leaves the company and there is a rule in there that says when you resign from the company that you must sell your shares. And again, that's one we're reviewing, and I'll talk about that in just a second. So that's effectively what we did. We wanted to get this as simple as possible and take all of that sort of heartache out of it. Just one second. We wanted a consistent valuation, and there is a formula in there. So again, same issues that Steve was talking about. Our financial year finishes at the end of June. We work very hard to get our accounts finalised and published. Our valuation is based on our accounts. It's a percentage. It's a formula based on revenue, on profit, and on net assets. So at the moment, I can tell you it's 1 times revenue plus 2 times EBIT plus net assets, and that gives you a gross value for the company divided by the number of shares to give a price per share. And we have had that formula in place since we launched this scheme in 2008, so it's been very consistent, and obviously there's a necessity to be consistent, to be fair and reasonable to all shareholders no matter when they buy. There are question marks come up around about that, and so when I talk about some of the issues we've had post-implementation, I'll talk a bit about that. The shareholding is in the parent, in Metech Holdings. Metech doesn't actually trade, it's just a holding company. So as Angela introduced us, I'm the MD Acquire, and that's one of the group companies. It's the largest company in the group, but we do have a trading company called Adapt as well. And there's been talk amongst shareholders or different employees of each of those companies as to why or why not couldn't they buy into one company or the other, rather because they work in that particular company. Now this actually did cause us a lot of grief prior to having the scheme when we just had the 4 founding shareholders, and issues about how those group companies work together caused us a lot of problems. We have a shared function in terms of administration and our IT function, and who pays for what starts to get in the road of actually trying to do the to run our businesses. Whereas we're looking at a group. So we said there's one shareholding in the parent company, and the parent company is a 100% owner of all subsidiaries. So when you buy a share in Metech, then you share in the group at exactly the same percentage that every other shareholder does. We also decided to go cash only. We're not funding this. This is a commercial decision made by an individual to invest in the company that they work in. So we weren't going to offer options or time payment over a period or deductions from salaries or what have you. The person has to weigh up the merits of it and make that decision themselves. So that sort of took away a lot of the angst. There is a slight softening in that. We do have a loan facility, but that is effectively a separate issue where we will lend up to a certain percentage of well, up to 50% of the minimum buy that people must make in the first time they become a shareholder. But that's a separate loan between them and the company, and is governed by all sorts of ATO rules and what have you around the commercial nature of it and the interest rates. But effectively, people have to come up with the full amount of the cash up front. There's no sort of working it off over a period of time. So we got this up and running in 2008, and the issues that have come up, I suppose, since then that we've had to deal with or are still dealing with, affordability. So by the employee, we have, when we first started talking about this, and as you note on a previous slide, I talked about this having to be a significant investment. So you can't put $500 into it. We started talking originally about $100,000 as a minimum investment into the company. That did seem to rule a lot of people out, so we cut that back, and the final version of it brought it in at $50,000 was the minimum investment to get into the company, and then in blocks of $5,000 over and above that. That has also caused affordability issues. So many people who are probably more mature, their mortgages are paid down, what have you, could afford to do that, but there's a lot of people in our organisation who have been here for significant periods of time who are still young. We've had people here who have started as 17 and 18-year-olds or as graduates, and in their mid-30s, they've still got large mortgages. They're still having, they're having children, they're getting married and doing those sorts of things, and the affordability is a problem. So after really, I think it was 1 or 2 years, we brought that back down to $25,000 as a minimum investment. And that's when we brought in the loan ability as well. So people in their first year could borrow 12.5 from us, but albeit that's at commercial rates because of the rules around loans to employee shareholders. Now that also gave us, it's continued to give us, should I say, problems in our international offices, because this is, we work on what we call a one company model. So to explain what that means, maybe I'll give you an example. We don't look at profit centres in our regional offices. So whether South America is making money or North America is making money is not that relevant to us. It's more about, as a group, how we're performing, which helps us. So there's no issues. If we have to send a person from South America to do some work in an implementation in North America, nobody's arguing about who's getting what revenue or who's spending what. So that's part of the one company model, and that flows on to one company says we want every employee in the group worldwide to have access to buying in as a shareholder. Now, originally we made these decisions based around conditions in Australia, but we're finding, $25,000 in, let's use Johannesburg or Santiago as a example, is significantly more money given the cost of living in those places and the relative wages of people. And again, we want this to be anybody in the company able to buy into it. So whether that's the receptionist in Santiago or the managing director in Perth, we want it to be a realistic goal for people to be able to do that. So we then had to change the minimum buy-in again to reflect the international nature of it. And so we now have a regional factor, which means in Australia you still have a minimum of $25,000 you have to spend to get in, but in Johannesburg, for example, the minimum is $10,000, I believe. So that takes in regionality. So that caused us some issues. There's obviously ongoing international issues, such as our employees worldwide have FX issues. So they buy an Australian dollar denominated share and they take the FX risk. We don't. They can't get the benefit from franking credits, but that's their local tax office issue, and there's nothing we can do about that. So they have some additional risk factors that they deal with, which has resulted in us having probably a higher percentage representation of shareholders based in Australia than overseas, because there are those additional factors, but there's probably not a lot we can do about that. Affordability, when I say for the founders, it's what I mean there is what we're trying to do is hand over from these founders to the rest of the employee group. So they want to be able to ride off into the sunset one day and not have their house on the line. So, you know, the bank can take their house now if we go broke. They're not too keen on that if they want to go to the beach and then get a knock on the door that says, sorry, you know, we've come to repossess your house. So they want to hand all this over and give all the decision rights and the ability to run the company to the next generation of people. To give you some idea, I said we had 4 founders at the start. 2 of them between them owned 93% of the company, and the other 2 owned 7% of the company. And the idea is to get down to, as Angela mentioned, the shareholders owning 49% and 51% still held by the original founders. That's the goal that we're trying to get to. One of the and this is the predominant model to do that. Affordability is causing some issues around it, and today, 7 years after we launched the scheme, the percentages that we actually have are 85% for the 2 majority founders, 7% still for the 2 minority founders, and only 8% for the remainder of the company. And to give you an idea of numbers, the group at the moment has around about 120 employees, and we have 32 shareholders. So if you take the founders out, we have 28 new shareholders who, between them, even buying in at the rates that I was talking about, have managed to purchase 8%. So we're a long way from getting down to our 51% at this point. Now, buyback is an option for us, and that's something that we've looked at. So to buy back those shares from the founders is an option, and we actually have been putting cash aside that potentially could be used for that at some point. But you know, the capital gains issues and what have you, of course, against some issues around that, and I'll talk about that a little bit later. But that is causing us a little bit of angst as to how we do it. So there are affordability issues. The definition of the shareholder's role. We thought about this when we were putting this scheme together, and what I'm saying about that is, how do you differentiate between your role as an employee of the company and your role as a shareholder? So when we put it together, we made this very, very clear to people that when you buy in, your role is still to do whatever your particular role is in the company. It's not to look across at someone else and say, well, I'm a shareholder now and I don't like what they're doing, or I need to know more about what's going on in that particular operation. It is to be a shareholder. So we had to define that pretty closely. So put in rules and regulations on how that works. So it's like any other shareholding. We provide our shareholders with regular information on the financials of the company. We have annual meetings where they can come and talk about it. But they are not managing the company. They are still running their own, doing whatever their job is. And there's a board of directors on each one of our companies, including the parent company, whose role is to manage and run the company. And I would say that by and large, our shareholders have been very good at understanding that discipline, But from time to time, you have to reinforce that view. And although I must admit we're a very open company in terms of providing information and what have you, and we'll listen to ideas and feedback, but ultimately we don't want that to get away from people doing their day job, so to speak. So it hasn't been too much of an issue, but it's something you've got to keep your eye on fairly closely. The next problem that is really causing us some issues, and we're right in the middle of trying to figure that one out at the moment, is the definition of an employee. Now, we went along the lines of, just a standard. You have to be employed by the company, and I think we also had a minimum time, so you need to be at least 2 days a week. So if someone was coming in doing 2 hours, not that they were, but we were just sort of trying to understand what would happen if that was the case. So for example, if we hired a cleaner to come and work 4 hours a week, would they be entitled to buy into it? So we felt there had to be a bit more buy-in than that, and I think we went for the minimum of 2 days. But by and large, it's somebody with an employment contract, either a director or an employment contract with the group. Now, the issues that have come along since then, immediately the issue that came up was we have contractors work within our group. So people who are legitimate contractors who do work for other other companies, but also come and work for us, say that minimum 2 days a week, and they send us an invoice. And unfortunately, we haven't been able to accommodate them. And these are people who would have worked for the group for maybe up to 15 years. They're part of the furniture. They've been here and been delivering the service. They come to all our Christmas functions. They're just paid in a different way. Under the current rules of the shareholders agreement, they can't be employees. And we've always felt that this is a bit of an anomaly. We've also struck the issue when, I'll give you an example, we had a shareholder leave Australia and go to work in the US. We don't have an entity in the US, but he's still working for us. The most simple and elegant way to solve that was he just sends us an invoice. So he's opened his own company, acts as a sole trader, works for us, and sends us an invoice once a month. Technically, he's not an employee. Therefore, he would be in breach of, or we would be in breach of the partnership agreement. But there is a clause saying that the directors can defer that decision to us and to sell the shares for indefinitely if they feel it's in the interest of himself and the company. But it does cause us some problems. We are now, as I mentioned before, going into a different business as well. So we're opening up Adapt. Now, Adapt is looking at totally different business models to the rest of the group has run. And part of it is our business development team are effectively independent contractors or independent consultants who will, we're still working this one out, may or may not bill the customer directly. So they may work for our customer and bill them directly, or they may work for our customer and then bill us and we bill the customer. However, again, they're very, very close to us, and we would like these people to be able to be shareholders of the company. However, there are legal issues around doing that, if we and we're right in the middle of trying to figure that out. So potentially, we might need to become an unlisted public company, and that again, I haven't got my head around what that means. I'll be honest with you. We haven't looked at it that closely. But I don't know what it means in terms of administration and paperwork and all the legalities that go with that. But in this changing nature of the world, how we work is changing. We're not absolutely certain our current plan is going to keep up with that. I suppose that's the message I would give on that, and it's pretty hard to future-proof it, and we have to look at how that model's going to work. So that's an issue for us. Liquidity is an issue. Now, Steve talked about this as well. So again, this comes around. Okay, we only have the once-a-year trading, which we're relatively happy with. But again, it's a willing buyer, willing seller based on evaluation. So if you have 100 shares available for sale and only people only willing to buy 50 shares, then you can't necessarily dispose of them. Or vice versa, if you want 100 shares to be purchased and only 50 want to be sold at that particular price, then you've got a shortage as well. And there's obviously no supply and demand mechanism that drives the price up and down until there's an equilibrium where shares for sale and shares to be purchased match each other. We haven't had a problem with that to date because effectively the largest two founding shareholders have guaranteed that they will sell and supply shares to anyone who wants to purchase. And to date, in 7 years, it's only been founding shareholders selling, and we haven't had any of the newer shareholders wanting to sell. There may be an issue in the future when, let's say, somebody else wants to exit the company and they want to sell their shares and there are not sufficient buyers. Now, does that mean that we're going to have to, we have the option of doing a share buyback and the company buying them back? Does that impact if that shareholding is large enough on the cash flow of the business and what have you? So that's an issue for us, and I'm not sure exactly what we do about that at the moment, but it's something we have to consider. Disposal is another one. So we recently had our first shareholder leave the company, resign. And we're working on a model at the moment that says you don't have to sell them straight away. And the reason behind that is people put in a big effort here. They're here to build a company and the value in that company, and sometimes through just circumstance, they don't get the benefit of that. So, we work predominantly now in the mining and exploration industries, and I don't have to tell any of you that's very, very flat at the moment, and it's a challenge. So it's a challenge to make a dollar, it's a challenge to add value to the company, and it has been for the last 2 or 3 years, and people have been working extremely hard trying to do that. Is it fair that somebody holds shares for 10 years and then, through whatever circumstance, leaves and dips out on the value in their shares simply because of the cyclical nature of the mining industry, and whereas somebody else may leave or retire or what have you at the height of a cycle and do extremely well? So we're looking at this model where you can hold shares for a period after you leave, and there's some discussion around how long that should be or whether in fact we should do it or not. So that's another issue that's up there for discussion. The final issue I've got there in terms of post-implementation issues is one that's only just recently raised its head. And it's again because we've gone into a different business, the Adapt business, which has nothing to do with mining or of selling technology. So is our valuation method for the group relevant to the different types of businesses that are within the group? And let me just give you a small example of that. As I said before, we use a formula which includes revenue in it. Now, and again, I gave you the example where the Adapt practitioners who work outside the group may either bill the customer directly for their services or may bill us and then we bill the customer. Now, under strict accounting standards, if they bill us and we bill the customer, then what we bill the customer is our revenue and our cost to them is an expense. If we use revenue as a measure in our valuation, then it changes depending on which method of billing the customer we choose. We don't want to make those decisions based around share valuations. We want to make it around commercial issues, what works for us, what works for the customer. and not peripheral ones. So it can drive your behaviour to do things differently, and you've got to be very careful about that. So it's the first time we've asked ourselves, how does our valuation work in other industries? And again, for anybody listening here, obviously you'll work in different industries, so you have to look at that yourself, but I think you have to be flexible. The question will be then, if we decide to value in a different way, how can we do that in a fair and reasonable way to current shareholders? So if I buy shares now under one valuation scheme, and then we change that going forward next year, is that fair to me, or is that unfair? Is it fair to the next shareholder, or unfair? So these are actually quite complicated problems that that we have to deal with. So those are the issues that have come up post-implementation for it. And I suppose, before taking any questions, the one thing I would say to you that we have learnt out of this process is do it sooner. Do it as soon as you're actually thinking about it. And it is so much simpler to do when you have a smaller organisation, logistically and just bringing people on board. But probably our biggest issue is valuation. So the problem we've got there, trying to get down to our 51% holding of the founding shareholders, is simply scale. When we first started talking about this model, or talking about wanting to do it, it was a long time before we really got serious about it. It's several years, and the valuation of the company was probably at that point maybe a seventh of what it hit at its peak. It's come off a little bit now, given the slowdown in the mining industry, but it's still maybe a fifth of the value of what it is now. To do something and to be able for people to afford to get the handover earlier is so much simpler. We're now running into very big issues around the scale and the volume and the value of the business trying to hand it over. That's probably the major lesson to take out of this. So that's our story. I'm happy to take any questions.
Thank you, David. That was excellent. Really, really good to hear your story and very comprehensively discussed all of the issues. Is there any questions from the floor from anyone? I realise we're running a little bit over time, so I apologise about that. But is there anyone else who has any questions for David? I'm going to open just two more final questions to close off if there aren't any more questions from me, and this is both to David and Steve. I guess if there's any advice that you're giving companies thinking about it, what would it be? And I think the second question, if there was anything that you'd like to say to government to say these are the things that you could improve, what would they be?
Well, I'm happy to answer both of those. First up, Angela, if you want. Well, really what I've already said, do it. The advice would be to do it as soon as you think about it. Get on to it. It does take a long time to get a fair and equitable model in place that's going to suit your workplace and your company. It's certainly not a cookie cutter approach where you can say, let's look at somebody else's and just grab theirs. You really do need to consider the people and the reasons you're doing it and why you want to hand it over. So do it sooner. And the second point would be to keep it as simple as possible, which is why I think people try and move away from sort of a registered employee share purchase scheme and just do, and that's probably why Steve and I both come down this road where we use that willing buyer, willing seller, and just have an exchange of shares between individuals based on a valuation. So those would be my two pieces of advice: do it sooner and keep it simple. In terms of the government and what they can do, for us, one of the major issues we're looking at, and I mentioned it in there, was looking at a buyback option, and there becomes a liquidity issue of funding that. and it's very difficult to just raise that funds and buy out our major shareholders. Now, we have raised some funds, and we're not saying we're going to use them for that, because they are what we call our future fund, which is also there for a rainy day. But we may decide at some point to use them for a share buyback. One of the issues that always crops up is the tax issue on it. So in this particular case, clearly our founders would have significant capital gains tax to pay. And there's no problem with that. That's life. We all have to pay our taxes, and it's one of our values in our company that we're a member of this community, and we're here to pay our tax and support Australia and all the communities we work in well. But the problem being, we would like to be able to lock in a price, because as our valuation grows, the scale of it becomes more and more difficult, to the point it will become impossible for us to be able to buy back significant numbers of shares from the founders. So we'd actually like to lock in a price for them. If we buy it at a discount, then all sorts of other issues arise. If we lock in the price now and don't pay them, then the capital gains ticks in at that point when the tax event happens. So the reality is, for us to buy a significant number of shares back from our founders, all of the cash we have available to do that would go to the government on capital gains tax. So the founders would actually have no cash, and we'd have no cash. And I don't think anybody would be a winner, and we would have a loan for the balance of that to people, which would have to pay out over a period of time. So to me, if the government could look at matching the tax to the cash flow rather than the tax event on these, would be a really big help. It would, I have no idea whether that's an option or not, but that would help us tremendously if we could do that. And then when we paid it down, even if it was set in stone over a period of 5 or 10 years, paid it down and paid the relevant tax at the time, but able to book that rate that we owe them, so today's valuation, rather than just the increasing valuation that makes it more difficult. So that would be my wish list.
Thanks, David. And Steve, yourself?
Yeah, thanks, Angela and David. So advice, the first question about advice, I think I'm in similar lines to David, but really I think it's useful to document the principles. It's kind of like having a vision statement for what the scheme is trying to achieve, having that very clear, but then having the detail, and we benefited from having some of the detail less prescribed and able to change over time. So as long as you understand what the principles are, then and people are acting in good faith, then having flexibility around the details does help with flexibility, which is important, especially with small businesses as they grow and change. The government, I'm interested to learn more about developments in this area. I think, I was frustrated by by having to conduct essentially fully commercial transactions when there's no sort of recognition that an employee-owned company is, and I really believe this is a more efficient and productive type of company, and it's more equitable, I think. So I believe in the model, and I think it would be nice if that was encouraged. I think a lot of other companies could benefit from having more, from going down this path. So having some recognition in the form of policy, or whether it be tax incentives, or some other recognition that that it's an encouraged and endorsed model from the government. It's interesting that all business has a CGT rollover relief on retirement. Again, that's an example of where policy was put in place to recognise a certain type of company. I think something similar could be considered for employee-owned companies and more in terms of
Hi, Steve. We're just struggling to hear you. I wonder if you could get slightly closer to your speakers and just repeat perhaps the last section of that. Sorry.
Okay, is that any better?
That's perfect.
The audio. Um, so on the second point about the government, I was just mentioning that it would be nice if there was some recognition that employee-owned models are endorsed and encouraged, and that could be via tax incentives or other forms of encouragement, I guess. And I was just touching on the fact that I'm aware that in the small business, very small business space, there's, for instance, capital gains tax relief for selling the company and rolling the money into super. So, whether some sort of consideration can be given to creating some incentives for people to go down this path, because I do think it's good for Australia, especially now as we move away from the commodities economy and more into the small business and innovation and space. So they're my thoughts.
Fantastic. Well, I want to thank everyone who's attended today. Is there any final comments from the floor or anyone who'd like to add anything to any of the comments made by the speakers or any further questions? Okay, well, thank you both to Steve and David. I really appreciate your time today and for being so open on sharing your stories. I've learned a lot myself, so I'm sure people on the call have as well. So thank you very much. And again, thank you to everyone attending today. This recording will be available as well on our website for later, and we'll share the link with you if you want to share it further with people. So thank you very much, everyone, for attending today.
Thank you, Angela.
Thank you. Thanks.
Thanks.